Hello everyone. This is Addy again. Hope you're all having a good time, good week, wherever you are in the world. This video is about option Greeks. So we covered the option basics in the previous one, and now I am going to talk about option Greeks. I know I touched it a little bit in the previous video, which was only a brief introduction of what the positives and the negative numbers are. But here's the main one. So delta is our main. It's a main driver of revenue here in this course. Well, I'd say revenue and risk management is done through delta. We basically keep a close eye on our delta position. What is delta? Now, delta is of an option. Is basically a change in price of $1 change in price of the underlying asset. Here, the underlying asset in our course is /ES, which is the S&P 500 futures. Now, I'm going to do separate courses on especially just the futures part of this, but because there is nothing such as selling, well, you can short futures, yes, why not? But you don't collect any premium. Whereas here in the options market, you have you have to be directionally right in the underlying asset spot market if you are selling it. Here you can buy it, sell it, do whatever, and you can still be right. If the market doesn't move on you, even if it does, you can still collect money. And that is the reason we like options trading. Options in the stock and the equity markets, and options in the futures markets. Now, I trade all the main products that are available to trade for a retail trader on TD Ameritrade. TD Ameritrade is my favorite one. I can give you a demo of the whole platform, whatever. Obviously I don't know everything. I know a thing or two about it. I've been trading on it for a while. Anyway, so here's what the delta is. The delta of the option, and we will go on the platform and then look at it as well. Theta, again, a measure of decline in the value of an option due to time decay. This is a main driver of this volatility, delta. All of these are delta. I would not say, because we are not direction agnostic. We are mostly seller into the strength of the market. We don't really care about the direction of the market here. We sell and collect premium where the volatility is, and whichever direction the volatility is in. So if the market is in decline, we go reversal strategy. It's basically a reversal strategy, a risk reversal that you call it, right? In your books, you must have read about risk reversals. You are basically a contrarian to the market. If the market is down, you go long. If the markets are up, you go short. On the upside, though, because the markets are there's a drift in the market, meaning there's an upside drift in the equity market. 70% of the time, the markets go up. So we like to stay away from that call side option premium in equities, especially. We love selling puts. We love on the downside when volatility is high, you get 3 times, 4 times more premium. Your risk reward ratio looks better and better when the markets are down. And then on the upside, we use commodities. Commodities have some call skew, so we sell the upside in commodities. But on the index side, yes, we do some index call spreads as well. We basically do everything and anything under the roof where there is volatility. And then whenever that is, we just sell it. Next one, Vega, measure of volatility. How volatility changes price of the options. You will see the difference when volatility is low versus when volatility is high. You will see the difference in options prices. I will show you the difference, honestly. When volatility is above 20 in VIX, VIX is trading at 22, 23, 24 handle, mid 20s. You will see your risk reward ratio will jump up, meaning you are getting more bang for your buck. You are getting more rewarded for taking that risk because the premium is higher now, juicier. Last one is gamma. We don't really care about row and all the others, the BANA and the BOMA and all the other second differentials. We don't really care about those. These are the main ones. Gamma is, again, it's the rate of change of delta. So this is affected by the days to expiration. Last 15 to 20 days, last 10 to 15, 20 days, gamma is at the highest. It can just kill your account if you're on the short side of it, or the options. So we try to manage this gamma um, positions as well. And that is it for the option Greeks part. Let's go to the theoretical part of it. Let's go to the trading platform, and then see how that goes. What we're looking at today is October 17th, and markets are closed now. It's 2:52 p.m. on the Pacific side. These are closed markets. I do apologize. I always tend to record videos when the markets are closed, but the ES is trading exactly at 4,400. This is a good level for us to take a look at. And because we'll be trading futures options, we'll take you through the futures option chain. On top here are all the features. You see the expirations, and we will talk about these later. Do not worry about these right now. Don't even actually look at it. We will talk about every single thing here later. I just want to give you a quick review of the Greeks on the positive and the negative sides. Here, 31 days to expiration. Yes. Let's buy and add the money put for $150, right? Look at this. The cost to buy this put at 4,400 is $150. Now look, if you want to buy this, if you want to buy this asset, we first analyze the trade. It's a call option. It's a put option, sorry. So obviously it needs to go down, right? So from 4,400, the price needs to go down by at least $150. So 40 to 50 is where I start breaking even. That's where I start breaking even, and anything beyond that is my profit. Anyway, look at the Greeks here. Delta negative 48 because I just bought an at the money almost 50 delta option. Gamma flat, no gamma yet. Theta is negative for buy, so long side of the options, theta is a negative, and Vega you're buying volatility when you buy an option. Now look at the call side, same thing. It's just the opposite. Delta is positive, theta is always negative for long options, and Vega is always positive for long options. So just keep that in mind. And that's why we're a seller of the options. So here's the example of the sell side. You collect some negative deltas. So when you short the market, you want to sell the calls. And that's when you collect positive theta. And you sit on this. And then when volatility is high, you're short vol. Because vol is mean reverting. That's the crux of our trading. Vol mean reverting. If you look at the VIX trade, and let me show you VIX. We'll come back to this one. But let me just show you VIX first. The VIX product. I need to select the right one. Let's see. VIX is also a CBOE market index, and you just want to see the chart of it. See, look at this. If you have to draw a line, this is a 1 year chart. Look at the 3-year chart. Weeklies is fine. If you have to draw a line, it hovers around 1780, 19 handle. I will draw a line in the middle here. That's where it hovers, right? You can change this and then do whatever time frame you want, but 3 years is a good time frame to look at. I normally leave my charts at 1 year's dailies. I want to see a 1 year chart with daily config. So we believe VIX mean reverts. So the reason I say that is because when it goes up here, look at this at 30, it comes down to its mean reverting level of 15, 16, 17. What else can I show you? If it goes up to 32, you can go back to pandemic level, and I cannot in this chart. I can do that in the 3-year chart. So if you go back to the pandemic level, okay, 2020. This is still 2021. Why can I not go back? This is still 2021. Okay, so even 3 years, it only goes back to like November 2020. Here at 41 comes back. So we believe volatility is just to give you a snapshot of what volatility looks like. It's a mean reverting asset, so we sell this. We sell the hell out of this volatility thing. Okay, and in order to sell this, you have to sell an option. We sell a product. We sell an underlying, and when we sell an underlying, we sell either the call side or the put side, and that's how we trade. Simple as, and that's why we like short vol. And when vol goes up, we try to short volatility. One more thing, I was here at 150. If I go into the analyze tab here, the trade's not there. Let me just bring that in again. Anyway, that's the gist of it. The long and the short of it. Take this out. Let's leave one in there. So the call side is here. I've talked about calls. Let's talk about selling. So selling a call is short. So obviously the underlying asset needs to go down in order for you to make money. And then you have to click this. Now that's the bid ask spread right now when the markets are off. Obviously this thing is not accurate. What else? Selling a put. So this would be the long side of it. So positive delta, meaning the market has to go up for you to make money. Anyway, that's the gist of it. Those are the option Greeks. If you have any questions, please leave a comment, a message, and anything, and I'll get back to you as soon as possible.